There you go.
Have you guys given any thought to like walk-on music for either one of you for this?
I've always pictured if I was a professional baseball player, what my walk-on song would be as I'm walking up to home plate, but no, not really. It'd probably be something really embarrassing.
I've been watching some Tulsa Kings, so I don't know, maybe like a Rocky theme. I don't know, maybe.
The other night, this is what I do, on a fancy, glamorous Saturday night. I went down some rabbit hole, ended up watching like the making of Rocky. There are 3 or 4 episodes, the making of Rocky. It's a pretty interesting story, but it's hard to believe that movie is almost 50 years old.
Yeah, it's depressing.
Yeah. Anyway, welcome everybody. We appreciate you spending a little bit of time with us talking about capital markets here on a Tuesday afternoon as we careen towards Christmas. And Christmas this year it's an issue because, as you guys know, Christmas is in the middle of the week, and then New Year's is in the middle of the week, the following week, and there's always that hedging question about, first of all, does anybody want to lock a loan, a day like Christmas Eve or the day before Christmas Eve or like later that week or December 31? Marcus, when you were running capital markets departments, how did you handle holidays like that? Was there anything going on? Did you just back pricing off? How did you handle that?
I'll back up even further. When I was just working the lock desk, we would kind of inadvertently argue who got to work the days leading up to Christmas and after, like who would still be on, because we wouldn't really have anything to do. And you pretty much got paid to hang out, and thankfully my previous bosses are all retired at this point. But you pretty much got paid to hang out and relax. On the cap market side of the house, when you're kind of higher up, I mean, honestly, you kind of know your salespeople. I'm coming from a retail perspective, that is, like, we knew who was out of town, who was working.
Who
We
was
kind of,
naughty? Who was nice?
yeah, exactly. Right, like we would follow some of our coworkers on Instagram. We'd see they're traveling like Ira right now, out and about, looking at fun stuff, not mortgages. So you just kind of had a feeling for what was going to come in and not. And it was always like minimal, like a small fraction of what you would normally get during a day.
Right. Yeah. Like I said, what borrower wants to lock a loan on Christmas Eve?
Yeah.
Really? Nobody. I remember, Rob Kessel, you will appreciate this. Back when I was under Paul Tuttle's wing, there was some pricing problem on some jumbo loan, some jumbo program. And he's like, we got to go back historically and enter these rates and these rates and, run an analysis and do a regression and so forth. And I was low person on the totem pole. I think at that point it was Paul Tuttle, Art Yend, and me. And so I had to work until 3 o'clock Christmas Eve, entering, like RFC yields or
High
something.
yields.
Everybody had left, and I was sitting there thinking, anyway, all right, enough of that. Enough of my lower lip quivering. So since our last time together, we had an election. I know it's the news is soon forgotten, right? But we have had an election. Mr. Kessel, when I say we have a Trump administration coming our way, where does your head go?
Well, I mean, I think there's always a conversation about what happens with the agencies and who's in charge of FHFA. And for our business, what does that mean? I think that that we go back to thinking about what Calabria was maybe pursuing, and I think you recently talked to him, right, for an update. But I think it's very much dependent with who's in, and who gets in at FHFA. And the dynamics are that they're printing, the agencies right now are printing a lot of money for the Treasury. And, there's a lot of priorities, tax cuts, et cetera. And it's money coming in that, maybe has low visibility to the public. So, I think there's plenty of scenarios. I wouldn't bet a lot of money on certainly privatization. I mean, that's a whole other conversation. Maybe they back off on some of the cross subsidization, some of the affordability methodologies. But I'm not quite sure there's going to be, sea changes with this administration, but just one opinion.
Interesting. Marcus,
Um,
what do you think? And you can
Yeah.
take your poly hat off here a little bit.
I'm with Rob on that. I mean, I honestly don't think most Americans even know that part of their mortgage payment is going to the Treasury, right? But I think most people just think like I paid my mortgage, it knocks off the balance of my bank, and we're done. So from a privatization standpoint, it's going to take years to pull off. There's a ton of money coming in. I mean, why stop that gravy train? I don't know. Maybe they roll back on some of the more like DPA and assistance and grants and all that, but generally speaking, I don't really see much happening, drastically at least.
How about you, Rob? Do you have a big difference on that, or?
Well, sure. I'll play devil's advocate, which I often do. But lest I forget, which I'm not forgetting, but thank you very much, Marcus and Polly, for sponsoring this show. We very much appreciate it. And I continue to hear good things about Polly. So, despite Marcus working there, the company seems to be successful. The when the election happened and the results came out, and what I heard was that there are two basic things, two basic camps, two basic subjects that are out there. One is the regulatory environment, and the other is interest rate environment. And along the sign, I shouldn't say interest rate environment, but capital markets portion of our world. And every lender out there, of course, has to deal with both the regulatory environment and the capital market side of things. And the capital markets includes Fannie Mae and Freddie Mac and what might happen to them, and what other products there are, like non-QM or jumbo, adjustable rate mortgages, and so on. And on the regulatory side, what's going to happen with the CFPB? Is it going to be defanged? What's going to happen with, if it is defanged, are states like Illinois or New York or California going to create even more mini CFPBs that nationwide lenders are going to have to deal with? But this is the capital markets call, so we'll go back to the capital markets portion of this. As you guys might recall, the day after the election, rates shot up. It's like, oh my gosh, all this tariff talk is going to have an impact on rates. And then I started fielding questions in my email. What's a tariff? Who pays for the tariff? How is the tariff collected? So you have to kind of brush up on tariff talk. But in general, it seems like Donald Trump's campaign proposals are being viewed as somewhat inflationary. And then, Jerome Powell is how long is he gonna be ushered out somehow? Trump administration does have a lot of momentum coming in, so it can do a lot of things that other administrations might not be able to have done. But in general, I would kind of concur with both you guys. But let's come back to Fannie Mae and Freddie Mac, and then I'll touch on interest rates here in a little bit. Marcus, what do you see happening with regard to the agencies? Because that's a big question out there. Are rates going to go up? Are they going to raise their G fees to get more of a war chest? Can they afford to raise their G fees? Some of their rates are definitely approaching non-QM kind of DSCR rates. what do you see happening with regard to Fannie Mae and Freddie Mac specifically?
Well, I'll kind of share the data that we've been seeing on the back end. There was like that 8-week period where we did see a mini, I don't want to call it like a refi wave, but definitely the percentage of refis doubled for about 2 months. I think it was between like August, September, October, maybe around that time. Since then, rates have gone up and they've eased back based on our lock volume. Where it goes in the future, I mean, kind of to your point, it really comes down to, I don't think Fed Chair Powell I think he's going to hold out till whenever his term expires in 26, and then my guess is he'll get replaced by then. But I don't see rates coming down in a meaningful way. I don't see them going up either, but kind of hovering in the unfortunate high 6s, low 7s territory. I don't know about you guys.
Rob, thoughts on?
Well, I mean, with respect to G fees, um, I think that so there's a couple scenarios. One is that maybe someone gets in at FHFA that pursues privatization. There's still this capitalization levels that were laid out by under Calibra that could either be revisited or attempted to meet. And those are sizable capitalization levels that would, probably, I haven't looked at the numbers in a long time, but probably would require bumping up G fee to kind of put them on a path towards having that kind of autonomy to where they'd be sufficiently capitalized. And I think that, runs a little bit counter in some of what, Trump campaigned on, which is inflation, a principal piece, or at least a chunk of it, of which is housing, right? And so I think there's going to be some sensitivity to not increasing the cost of housing vis-a-vis higher interest rates through their direct policy, higher G fees. So I think that that's kind of a little bit of a temperance there on, a push for a higher G fee or maybe even independence at this time. And, I'll just leave it at that. And, if we want to talk interest rates, we can come back to that because plenty to talk about on that front.
Yeah, I think what I had heard was, or the questions, the concern out there is, are Fannie Mae and Freddie Mac just going to become another non-QM investor in terms of, it's not like Deep Haven or Angel Oak or Veros or some of these other companies have any kind of government backing. And so is the government going to just cut loose Fannie Mae and Freddie Mac? In which case, what kind of yield will Fannie Mae and Freddie Mac have to offer its investors of mortgage-backed securities in order to attract them buying those securities? So people are out there saying, oh, rates are going to go up 1 to 2% on just agency product. I don't quite see that happening. I see, though, the administration and the FHFA, if they do re-embark down the path of releasing them from conservatorship, they have to do it carefully and hopefully have a lot of industry input. And sometimes I know that Kathy Graninger, when she was heading up the CFPB during the previous Trump administration, she was very open to industry input, way above, say, where Richard Cordray was. And so the industry liked having her there because she was interested in what the industry had to say, because there's a lot of collective experience in our industry. Hopefully the same thing happens with regard to the FHFA and the leadership there and management, because if you start having missteps, it can be very expensive to interest rates. And who pays for that are the borrowers, especially first-time home buyers and so on. So going back to Marcus, do you think that so let's go back to interest rates briefly. What do you think folks on the call here should pay attention to with regard to interest rates going forward? I guess next week we've got a Fed meeting, and the Fed will do, well, first of all, what do you think the Fed is going to do and why? And then as we enter early 2025, what should folks on the call be attentive to in terms of the market?
Yeah. So you're right. There is a Fed meeting in 8 days, and I think the current bet on that is like another quarter drop in rates. But I would say going into next year, I don't know. There's a lot of uncertainty, right? Whether Trump follows through on his tariff plan, on if he's doing his immigration policy, what that looks like for inflation overall. I would say just be cautious. You know, don't plan on a huge boom in volume. Just play it safe. I don't know. I don't know what to say other than that.
You don't have a crystal ball, Marcus? Come on now.
Yeah, if I did, I don't think I would be on this panel right now. I'd be on a boat somewhere trading on my own yacht.
Ah, well, I am on a yacht having this call. No, I'm not. Sitting in Marin County. Rob, what do you think folks should pay attention to as we head into next week and beyond?
I mean, I think Fed can do whatever they want and do. I think the path will be to drop a quarter just under the guise of uncertainty, and there's just a ton of it, right? Um, there's all these potential policies that might be inflationary. There's Department of Government efficiency. I mean, there's you follow that at all. There's just endless amounts of possible cutting, and they seem to have tailwinds in that effort. That could provide some headwinds from the economy's perspective. So there's all these unknowns that have to play out. And so it's going to be volatile. And, maybe makes it easy for me to always repeat, don't have an opinion on where rates are going. Just, provide interest rate risk management and preserve your margin. So I certainly have no crystal ball, don't have a sense for where it's going. I mean, just coming back to the Fannie Freddie thing, I mean, I think there's privatization, but there's also the utility model, right? Where, they preserve the full faith and credit of the US government behind the mortgage-backed securities, which has been just a smashing worldwide success in liquidity and bringing rates down for American homeowners. And again, back to my earlier comment about inflation, I think, that inflation is too much of a headline issue for the administration to mess with, pushing housing costs up so much that a true privatization would entail. And so there's this utility model of 9% return. Maybe there's one instead of two, because there's, thousands of people between the agencies. There's all sorts of intermediate options that don't take away that full faith of the government behind the agency mortgage-backed securities. So I think that's probably at least worth keeping an eye on as far as where the conversations go once they pick the new head of FHFA.
So what about spreads, Rob? And by the way, how's the first semester of the academy going, and how does it look for the second semester? Let's ask you that.
It's going well. It's been a great experience. There's been, I think, probably 2 or 3 weeks that were particularly hard for the students. Cash flows from mortgage servicing rate valuation and some of the hedging stuff. But the students are in the last several days of their final project, and we're super excited about having pulled that content together. And I know, Rob, you're a kindred spirit, because we've talked over the years of trying to put a book together or collect all that content, and it's a huge accomplishment feeling that I finally, with help, put that all together. So real happy about that. There's going to be a first graduating class come Monday of next week, and then next semester, I think we're down to 5 or 6 spots left over. It's almost full already, and that's kicking off in January 19th. So we're pretty excited about it.
Yeah, I could barely string, an adjective and a pronoun together, much less write a whole book. So hats off to you on that. The class, well, getting back to the class, I'm sure you talked about spreads and what define for the folks on the call here. When you talk about spreads and mortgage spreads versus Treasury spreads, what do you mean, and why is it even an issue?
I'm sure. So, I like to kind of deconstruct the mortgage rate and kind of build it from the ground up. And so, First thing that we look at is, fixed income markets, what's somewhere around 10-year-ish investment alternative to mortgages. And so there's certainly treasuries, right? 10-year treasury notes. So that's kind of like our base yield. It's risk-free. And then when we think about a mortgage investment versus a treasury investment, obviously mortgage-backed securities have prepayment risk. And obviously the higher the coupon is relative to the market, the faster the prepayment, the greater the risk. And so their investors have to have an extra yield to a mortgage treasury or mortgage interest rate swap. It's just too less risky investments. And so that's the first spread. How much are mortgages trading above treasuries for, say, just pick a 10-year as reference point. So that's the first spread, mortgage treasury spreads, and that moves in and out based on the investor's demand for mortgages. And it's widened and tightened over the last several years just by fixed income investors' appetite and alternatives out there. So that mortgage spread can best be characterized by looking at the TBA market, which is that's the first mortgage spread, and you can look at TradeWeb or look at the coupon stack, and you can say what yield would be a par yield for 30 days out. So it might be like 560 or 550 right now, as far as if there was an actual TBA for a 30-day delivery that was priced exactly at par. And we use that as a measure, and we compare that to the treasury yields. And then from there, we go into our primary secondary spread as the second kind of big spread we talk about, which is, okay, so where are mortgage rates offered to consumers? How much is that rate spread over just a par TBA, right? And that's what gets us to our note rate. And that primary secondary is comprised of G fee, which we know has gone up. It's, servicing fee, and then it's margin. And, the margin is a story about LO comp and, its expense, but it's also increasingly lately a story about just how compressed the coupons are. Like when we try and get a 103 premium, so we can get a par yield out in a PPE, and there's just only a 1.5 difference between 0.5% coupon prices for mortgage-backed securities. You have to go up quite a bit to get that 103. The coupon prices are compressed. Borrowers like to have loans at par. And lenders and LOs like to offer loans at par, but so they want to bake their margin into their pricing. And so that's a second kind of the primary secondary spread kind of gets us from the TBA par price up to where mortgage rates actually are. And the combination of both those spreads. If investors are a little scared about a lot of prepayments coming because they think rates are going to drop, well, they're going to want a lot of extra yield for mortgages. That's going to widen that mortgage treasury spread. And then if G fees go up or compression happens or margin goes up, that's going to widen that primary secondary spread, the difference between the retail rate and the wholesale rate, if you will.
I think either consciously or subconsciously, the price spread enters into all kinds of decisions that we make every day. Marcus goes to the store and he's a big fan of buying the tomahawk steak. And maybe the difference between the tomahawk steak price per pound and the filet price per pound, let's say it's always $5. Well, let's say he goes into the store one day and it's down to $4. He's gonna be like, oh, well, the tomahawk steak is a better buy now. So he might go with the tomahawk steak. But people subconsciously, or like I say, consciously look at spreads all the time. The difference between, diesel and regular fuel, or regular fuel and premium fuel, or, looking at, you go out to buy a new car and they're changing over, and the spread between the 1 year older car, new car versus the new car, maybe it's, $1,500, and suddenly that spread narrows. So it might make you inclined to buy the older car or the newer car, whatever it might be. People are looking at spreads all the time. The difference in neighborhoods, difference in towns. Oh, gee, that town is always, $100,000 more, and suddenly a house comes available there, and it's only $50,000 more than the average price of the the other community. So that is viewed as a buy. So people are looking at spreads all the time. And the same with mortgage-backed traders and investors. They're looking at the spreads, to your point, between different instruments. And, gee, the spread between a Somalia bond and an Ecuadorian bond, or the county of San Bernardino bond versus the county of Sarasota, Florida bond, whatever it might be. Companies look at those spreads. But I think in your explanation, it becomes evident how complicated this can be. And I'm going to turn to Marcus now, because Marcus, Polly must have just a tremendous amount of information coming into your database all of the time. How does Polly incorporate all this information and give your clients an accurate assessment as to where a mortgage should be priced, where it is priced, and how they act together?
Yeah, so to answer that, I mean, it is a very powerful like data aggregation tool, not just for like the logs that come in, but obviously like rate sheets and putting all together. And Rob Kessel, to your point, I remember when I was in the retail side of the house, we would work with like local credit unions and release like an internal non-agency product, but it was never priced high enough in rebate to ever get a lock on it, because no one wants to pay to close their mortgage. What I'll say on the pricing side, our analytics do show that loans are constantly being locked below par these days, just because of your point about compression. There's I mean, you got to pay to close your mortgage, and maybe with life being as expensive as it is overall, the higher mortgage rate maybe is not as like to your point about the tomahawk versus the whatever steak you were referencing. I don't know.
Filet.
Yeah, they're right, the fillet. But we do have a competitor tool internally where we are taking all the data from everyone across the Poly platform, and we can drill down on like state, MSA, product, even down to the type of lender, whether it's a bank, an IMB, a credit union, and so on, or a wholesale lender, and really drill down on the specifics of how that lender is priced relative to everyone on the Poly platform. So there are ways to kind of take that data and get not a perfect look into your competitors, right? Like you don't really know, are they, if they don't put their fees in the system, you won't be able to see how much they're charging their borrower, but it is some insight into your competitive position relative to your peers.
And are I'm going to put on my old timers hat here, going back to having to collect price data and have RFC or GMAC or Lehman Brothers or whatever give you their yields and their information. How does Poly? I would imagine that the position that Poly occupies in the industry, investors, maybe it's non-QM, maybe it's whatever, they are only too anxious to give you their daily yields. Is that the case? Or do you have to like, ask them for it? It's an
Good
odd question, I
question.
know, but
Yeah, and that's a good question. There, in terms of like internal analytics amongst peers, we do have the data. I don't know that we share that as a service yet. I could be wrong on that one. I'd have to check with our marketing team. But that one's still tricky too, right? Like even if you have the data, then what? Like, are you really going to crush your margins to zero to try to compete? I don't know. It's a tough call. When I was on the retail side, I remember we would do like Icon. We use other services that would kind of track where we are competitively. But then at the same time, you have your CFO on the other hand, and your CEO going, well, we need to make this many bips. There's only so many levers you can pull in terms of like margin reduction before you enter a space where you're kind of going backwards by doing more volume. I don't know. At some point, it doesn't make sense to cut your margin anymore. So I would say the data is valuable, but there's also limitations on how far you can take it.
Rob, I wanted to ask you, you mentioned the final projects in the academy now. Is it a group project, the final project?
It's not supposed to be. It's supposed to be an individual project.
Ah, okay. And does everybody is everybody working on the same thing then?
Yes.
Are you at liberty to talk about the topic?
Yeah, so it's the life of capital markets. So it's figuring out how to uh, price a loan the best coupon securitization. It's figuring out how to derive a price and then and derive a margin stack and then back that out so that you can publish something to a rate sheet or PPE. It involves coming up with what hedges should be applied, how to express those hedges in a benchmark, duration ratios. There's coming up with MSR valuations using cash flows. And then there's a very exciting pair of assignments on attribution analysis. Why did the P&L change day over day, decomposing the changes in hedge P&L, and then also month over month for an MSR portfolio. So they're Excel-based exercises where they have to demonstrate their mastery of all those in Excel and derive the answers.
It's very complicated. In fact, among the first few sentences, you lost me. What is a margin stack?
Like it is dependent upon your technology, but so part of that would be LO comp and branch comp. Right, because when you start with in cap markets, you start with where can I sell a given loan, right? So a lock, 30-day, 60-day lock is going to go into some kind of delivery. And so what you've done in capital markets is you've done your best to have the very best execution for those kind of deliveries so you can be the most competitive. And so what you kind of start with is, okay, if I have a 30-day lock, how do I deliver that? And then you come up with your best possible price, and that's what you can sell the loan at. And then you got to back out everything before you publish that to the PPE. And so in our definition, the margin stack would start with LO comp and include branch comp. And then the corporate margin, as you go through strategies as to how you come up with that, some of it might be a hedge cost. Some of it is just how many units you're doing versus your G&A overhead cost. Some of it is around, competitive pressures and surveys and how much concessions you expect. And so those are all dynamic, and in many cases given to cap markets. When the recruiters go out and they bring on production, it's with a comp schedule, right? And so that's kind of the margin stack taken away from the very best price, and that forms the note rates and lock period pricing that then feeds into the PPE.
I feel, given that, I feel like a current med school student looking at surgery during the Civil War and comparing the surgery then to medical techniques now. Because when I got started in this industry in the mid 80s, it would be what's the MBS price? Add like a point or add 2 points and write that down and fax out the rate sheet. There was very little thought given to how much it costs to produce a loan. It was just kind of like, oh, it costs us this much roughly. And, if you had a point or 2 points or whatever, I should say subtract from the price, but we'll make money. It was so thumbnail sketch. And now you have the polys of the world out there who to use a term my dad was fond of, you can price things down to a gnat's ass. Excuse my language. In terms of that. And I remember talking to when you talk to the typical IMB capital markets of old, they would be asked for a price concession. Oh, can you give me an eighth? Can you give me a quarter? Kind of thing. Fast forward to today where you have once again, Pauly out there, I mean, you can probably go out to the 100th of a basis point or whatever it might be, 10th of a percent, in terms of what you should do or shouldn't do in terms of concessions and how much those things cost, how they cost companies, right?
Mhm.
So
Yep.
it's like I say, Civil War surgery versus modern surgery.
Yeah,
Uh,
sorry to be off there, Rob, but yeah, the amount of data that you can pull out of the system just for internal BI reporting, I mean, it's pretty crazy. Like you can figure out down to the loan officer, down to the loan, down to their lending profile of where the margin's going and if there is margin leakage or not, based on who you're selling to. I will say I got a funny story to share about this was probably a number of years ago, but we had hired someone in the lock desk that was born in the mid to late 90s that had never used a fax machine before. And one day, I think the Wells Fargo lock desk, the online system, the portal went down. We had the fax and lock request. And it was probably like a 20-minute training exercise just explaining how a fax machine worked and the whole process back in the day on you send your confirm through or request through, and if you got a confirm back, you're good to go, or you yank the cable out of the fax machine, your lock was never confirmed. Yeah.
yeah. Oh, we ran out of thermal paper,
Yeah.
whatever it might be. Yeah, it's there are those clips on YouTube where you ask somebody who's, 15 years old, you give them a dial telephone and what do you do with that dial telephone? Um, and when you ask somebody a little bit older, how would you like right now? I don't have a fax machine, and I ask somebody, what if somebody needed a fax or what? And they say, well, there's an app now that you can find and put a fax app on your phone to like run it over a document that's sitting on your desk. And it'll literally, you can have the ability to fax that image to a number. So, anyway, all right. Well, with that, should we wrap things up? Should we wrap up 5 minutes early here? You guys okay with that? Or any closing words? Any thoughts about the next, period of time until we meet again? We've got a Fed meeting.
I will say, Chris asked if I still have a fax machine. The answer is no, I don't. I'm 41, so my generation is if it's really important, you'll text me. You won't call or fax.
Yeah.
I've got nothing to add. Just wish everyone happiest of holidays and be safe out there.
We're
Yeah,
just
have a great
nodding
holiday,
down.
everyone.
All right, guys. Thanks. And thank you to Pauly for sponsoring the show today. And take care. We'll see you next month.
All right. Have a good break.